Welcome to the Opening Bell Report.
Welcome in, everyone. It is fantastic to have you joining us today.
Yeah, really glad you're here with us.
If you are looking to cut through the daily market noise, just get straight to the underlying signal, you are in the exact right place.
Absolutely.
We know you value a focused, respectful look at the data, so we have a deep dive lined up today that gets right into the mechanics of a major market event.
And it is a fascinating one.
It really is. We're zeroing in on a single, highly intriguing analysis report that just crossed our desks, and it is focused entirely on the trade desk.
Ticker symbol TTD.
Right, TTD. So the mission for our deep dive today is to dissect this recent, frankly dramatic market movement involving the stock.
Because the underlying data in this analysis report, it's just genuinely compelling to unpack. We are looking at a very specific anomaly here.
Yeah.
It's the kind of price action that speaks volumes about underlying corporate strength, institutional positioning, and just broader market psychology.
Especially right now. So the core question we are trying to answer for you today is pretty straightforward. TTD had this massive gap up. Is this the start of a huge reversal? Or are we just looking at, a temporary blip on a much longer downward trajectory?
Right, which is the critical distinction you have to make when allocating capital.
Definitely.
Because a single day, double-digit spike, especially in a volatile environment, it often traps buyers.
Oh, completely.
They mistake a momentary relief rally for a structural bottom.
So let's look at the catalyst that kicked off this entire analysis. The trade desk recently posted an explosive single-day gain. We're talking about positive 18.36%.
Yeah, a massive move.
A violent upward spike. The stock closed at $29.79. I mean, when a mid to large cap tech stock jumps nearly 20% in a single session.
It forces you to stop and look.
It really does. You have to examine the structural drivers behind the move.
It undeniably turns heads. But, as the analysis report cautions, you have to maintain a high level of skepticism here.
Sure.
Market veterans are intimately familiar with dead cat bounces.
Right, those brief, sharp recoveries.
Exactly. The price of a declining asset spikes. It tricks early buyers into thinking the bleeding has stopped, and then boom.
It resumes the broader downtrend days later. And nobody wants to provide exit liquidity for a head fake.
Nobody. But here's the thing. The analysis report argues heavily against the dead cat bounce theory here.
Yeah, the underlying mechanics of this specific move suggest something much more durable.
They really do. The report builds this robust case that we're witnessing a definitive macro trend reversal.
And it backs that up with a convergence of things. Valuation resets, elite cash generation, and this textbook technical breakout.
So let's dissect the anatomy of the surge itself, because the report is emphatic that we need to scrutinize how the stock moved.
Not just the percentage it gained.
Exactly. They focus heavily on this dynamic called the gap and hold.
Okay, let's unpack this for you. So the stock closed the previous session at $25.17.
Right.
But the next morning, it didn't just grind higher through the order book as the day went on. It violently gapped up right at the opening bell.
Jumping straight to $31.49.
Yeah, think of it structurally. Normally, an asset walks up the stairs, right?
Finding buyers and sellers at every step.
Every fractional price point. But TTD essentially teleported from the second floor directly to the penthouse?
It completely bypassed all the liquidity in between.
Teleported is the perfect word for it.
That analogy captures the mechanics perfectly. When an asset gaps that aggressively overnight, it indicates a massive imbalance.
Right. Demand was so overwhelmingly high that market makers just had to immediately reprice it.
Significantly higher, just to find any willing sellers. And this highlights a crucial concept in the report, which is institutional absorption.
Because retail volume regular day traders, they simply cannot force a dislocation of that magnitude.
That is the operative takeaway here. A gap up of this scale requires billions of dollars moving simultaneously.
Billions.
We are seeing the aggressive footprints of mutual funds, pension funds, large-scale asset managers.
They aren't scaling in slowly.
No, they are demanding immediate execution. The smart money is rushing to secure positioning regardless of the overnight premium they have to pay.
But let me challenge that for a moment, because usually a massive pre-market move like that runs out of steam by, the 10:30 a.m. window.
Usually, yes.
You get algorithmic selling or early buyers dumping shares to lock in a quick 20% gain. Did the analysis report show institutional appetite drying up once that morning profit-taking started?
And that is where the narrative shifts. From a simple volatility event to structural accumulation.
How so?
The report points out that the stock absolutely refused to fill the gap.
Ah, right.
In a weak tape, sellers will push the price back down to test that previous $25.70 close.
They'll try to close that empty space on the chart.
Exactly. TTD did experience morning profit taking, but it found a concrete floor and just consolidated sideways right at the $29.50 level.
Consolidating sideways after that kind of vertical move is incredibly bullish. It means every time short-term traders trying to take profit, an institutional bid wall was right there to absorb the supply.
They effectively exhausted the selling pressure at a much higher equilibrium.
Which brings us to the technical verdict of the analysis report.
The breakaway gap.
Yes, the establishment of a breakaway gap. This pattern occurs when an asset violently breaks out of a prolonged downtrend with undeniable momentum.
Leaving a literal blank space on the chart.
Right. And by holding its ground and refusing to retrace, TTD established $29 as a formidable new line of support.
It serves as a technical declaration to short sellers that the trend has fundamentally changed.
Now, technical breakouts are compelling, but they are just lines on a chart if the underlying business model is deteriorating.
Eventually, reality sets in.
Exactly. A breakaway gap will inevitably fail if the fundamentals can't support the new valuation. But here's where it gets really interesting.
Fundamentals.
Yes, the analysis report pivots heavily into the fundamental engine of the trade desk to justify this wild chart movement.
The technicals and fundamentals are deeply aligned here.
They really are.
It begins with what the report categorizes as the valuation reset. Historically, the trade desk was the undisputed darling of the ad tech sector,
Commanding a massive hyper-growth premium.
We are talking about a PE ratio that routinely hovered well above 100x,
Over 100x. I mean, it was priced for absolute perfection.
leaving zero margin for error in its quarterly guidance.
And a multiple that high makes any stock incredibly vulnerable to macro headwinds.
But the analysis report points out that the relentless market shifts of the past year have severely compressed that valuation.
Today, that PE ratio has been compressed down to roughly 32x.
A compression of that magnitude fundamentally alters the risk profile for the stock.
To provide a sense of scale for you, the analysis report compares TTD directly to its lead competitor, Applevan.
Right. Applevan is currently experiencing slower top-line growth than the trade desk.
Yet it trades at a PE ratio of roughly 44x.
That discrepancy stands out immediately.
You have the faster-growing industry leader trading at 32x, while a slower-growing competitor trades at 44x.
The historical premium that TTD used to carry has been completely washed out.
The report argues this essentially de-risks the stock at current levels.
Offering growth at a relative discount. It creates a margin of safety that simply did not exist a year ago.
And when you look beneath the multiple to the actual cash generation of the business, the numbers justify the institutional appetite.
They really do. The report characterizes their cash flow conversion as elite.
The hard data on this is striking. They convert 27.4% of their top-line revenue directly into free cash flow.
Almost 30%.
Yeah. In absolute terms, they generated $795.7 million in free cash flow on $2.9 billion in sales.
We should really unpack the implications of a nearly 28% free cash flow margin, especially right now in a high-rate environment.
Go for it.
Well, net income can be smoothed out, right? With depreciation, amortization, stock-based compensation.
Accounting magic.
Exactly. But free cash flow is unencumbered capital. Generating nearly $800 million in hard cash proves the core business model is highly lucrative.
And entirely self-sustaining. It insulates them from the credit markets.
That's the key.
When a tech company is burning cash, they are at the mercy of interest rates and venture debt.
Right.
But when you have $800 million hitting the balance sheet, it gives the management team tremendous offensive and defensive flexibility.
Which leads directly to how management is choosing to deploy that capital.
Yes.
The analysis report dedicates significant focus to a detail they call the $1.4 billion floor.
Over the past 12 months, the C-suite has executed a massive $1.4 billion share buyback program.
Let's look closely at that capital allocation strategy because a share buyback reduces the overall float.
Making every remaining share represent a larger percentage of the company's future earnings.
But it also signals something deeply psychological to the broader market.
About how internal management views the company's intrinsic value.
Right. And the math behind this specific buyback is where the institutional conviction really comes from.
It's wild.
The report details that over the last year, the average price the company paid to retire those shares was $52.60.
$52.60. Consider the opportunity cost of $1.4 billion.
They could have done anything.
Management could have pursued aggressive M&A, expanded their global footprint, issued special dividends.
Instead, the people with the deepest visibility into the client pipelines, the ad spend trends, the proprietary data models,
They decided the absolute best return on invested capital was to buy their own stock at $52.60 a share.
and we are analyzing a stock that just gapped up to the $29 level.
Think about that.
If the insiders who know the operational realities best felt comfortable deploying $1.5 billion at an 80% premium to current trading levels.
It severely undermines the bearish thesis,
Completely. They are effectively establishing a psychological and financial floor.
signaling that they view the current $29 price tag as a severe market dislocation.
They are weaponizing their balance sheet to engineer shareholder value while the broader market remains pessimistic.
So what does this all mean for the operational reality of the product? Because the financial engineering and the technical charts are incredibly strong.
Right.
But the macroeconomic environment for digital advertising has been brutal.
Ad budgets are notoriously the first thing slashed when corporate earnings tighten.
Exactly. That is the prevailing macro narrative. But the micro data for the trade desk tells a highly divergent story.
The analysis report points out that despite severe industry headwinds, TTD has actively expanded its market share.
Which is amazing. What I found most compelling in the report wasn't just the sheer volume of cash flow, but the stickiness of the platform.
The retention.
Yes, the report highlights that TTD has maintained a 95% or higher customer retention rate.
And this is not a short-term anomaly.
No, they have maintained that 95% plus retention for the 12th consecutive year.
Which is staggering. In the software as a service and ad tech sectors, switching costs can sometimes be marginal.
Clients will jump platforms for fractions of a cent in optimization.
Exactly. So maintaining a 95% retention rate over a decade is a statistical outlier.
It speaks to an incredibly wide economic moat.
Once an advertising agency integrates its data workflows into TTD, the friction of leaving just becomes too high.
The product clearly becomes deeply embedded in how these agencies operate. And if we connect this to the bigger picture, it explains their strategic positioning.
The analysis report defines TTD as the undisputed leader of the open web and connected TV ecosystems.
The vital phrase the report uses to categorize them is a conflict-free alternative.
And this distinction is paramount when you analyze the dominant players in digital advertising.
Because the ecosystem has historically been monopolized by the walled garden.
Meta and Alphabet.
Right. Those entities operate as both the publisher of the content and the technology broker placing the ads.
They own the inventory and they run the auction.
Which is a huge conflict. Advertisers have grown increasingly wary of platforms grading their own homework.
That structural conflict of interest is TTD's greatest competitive advantage.
The trade desk does not own a search engine.
They do not own a social media platform.
Or a streaming service. They exist purely on the buy side of the transaction, representing the advertiser's intent across the open web.
Because they have no proprietary media to protect or prioritize, they operate as a completely neutral, unbiased advocate for the ad buyer.
They are simply optimizing for the best return on ad spend, regardless of whose server the ad is delivered from.
And based on a 12-year retention rate of 95%, it is glaringly obvious that massive global advertisers heavily value that neutrality.
It also provides a secondary layer of protection that the analysis report touches upon.
Or the regulatory angle.
Yeah. By purely operating on the buy side and not monopolizing the underlying content, TTD largely insulates itself from the intense anti-monopoly and regulatory scrutiny that is acting as a major headwind for the walled gardens.
It's a massive strategic advantage right now.
So as we pull all these analytical threads together, the report offers a highly definitive verdict.
We set out to answer the core question, is this massive gap up the start of a huge reversal?
And the data presented builds a compelling case that it is exactly that.
It relies on a convergence of catalysts that rarely align so cleanly.
You're looking at a fundamentally cheap valuation relative to its historical multiples and its slower-growing peers.
You combine that compressed 32x multiple with a hyper-lucrative business model generating an elite 27% free cash flow margin.
You layer in a management team aggressively retiring shares at an average price of $52.60.
Establishing a massive confidence floor.
And visually on the chart, you have the technical validation of a breakaway gap.
Where institutional capital stepped in, absorbed the overhead supply, and cemented $29 as the new baseline.
Synthesizing those factors leads the analysis report to conclude that the risk-to-reward ratio has heavily skewed in favor of long-term accumulation.
The downside risk appears heavily mitigated by the fundamental cash flow and insider buying.
While the upside potential is significant,
Addressing that upside potential directly, the report provides a look at the current institutional consensus.
right, because despite the heavy multiple compression over the past year, Wall Street maintains an average price target on the trade desk of $56.
$56. And when you calculate the distance from the current consolidation level, around $29.79 to that $56 target,
It represents an 87% upside potential.
an 87% runway heavily bolsters the central thesis of the analysis report.
This gap and hold dynamic wasn't a fleeting dead cat bounce designed to trap retail liquidity.
It looks like the definitive structural end to TTD's downtrend, backed by billions in institutional capital.
It really does.
Reviewing the operational metrics alongside the technicals raises an important question.
What's that?
It's something for you to mull over as you analyze the broader tech landscape this week. If an independent, conflict-free platform can generate nearly $800 million in unencumbered cash, maintain decade-long client loyalty, and steadily erode the dominance of the walled gardens.
What does this signal about the future architecture of digital advertising?
Exactly. It challenges the assumption that the future belongs exclusively to closed ecosystems.
Are we witnessing the early stages of a structural rebellion by the world's largest ad buyers?
If capital is systematically migrating away from proprietary tech ecosystems in favor of the transparency and neutrality of the open web, the trade desk is positioned as the primary beneficiary of that macro shift.
It becomes less of a simple ad tech play and more of an index on the future monetization of the open internet.
That is a phenomenal perspective to close on.
The tension between the open web and the walled gardens will likely dictate the next decade of digital real estate valuation.
Without a doubt.
Well, thank you so much for taking this deep dive with us today.
It's been great.
We love dissecting these complex analysis reports and extracting the signal from the noise, helping you stay ahead of the curve with focused, actionable insights. Keep interrogating the data, keep looking for those structural shifts, and we look forward to having you with us on the next deep dive.
Don't forget to like, share, and subscribe for more.